alternatives is playing a bigger role because it's providing diversification, it's reducing volatility in your portfolio, and it provides you a way to access the full market. I think alternatives are moving into the mainstream. I'm very happy to be seeing that occur. I think there's probably a few reasons why they're moving into the mainstream. One would be, I think, correlation between the traditional asset classes of bonds and equities has increased. And so if you've got a traditional portfolio of bonds and equities, you're no longer exposed to the entire market, and you've also got a lot of correlation challenges, so they provide a diversification benefit to your portfolio. In the last 10 years, there's been almost a 30% drop in listed companies that are available for investors to invest in. You've got governments stepping out as a general rule around the world. You've got private investors stepping in to invest. And so you have this confluence of factors that is driving more companies staying private for longer. If you think about the majority of the economies, particularly in the US and even in Australia, the majority of companies are private. The introduction of alternatives into a traditional portfolio helps improve the risk-adjusted return, or that's why you would add an alternative, because you're looking for diversification. I think also access to alternatives has massively improved in the last few years. Our clients are talking about these asset classes and wanting access, and that's been a pretty big shift in the market. We have ultra high net worth clients, we have family offices, and we have what we call the for purpose space. And across the board, I would say their knowledge of alternatives and their interest in alternatives has notably increased in the past few years. I think what they're looking for is insight. What is appropriate to my portfolio? What should I be thinking about? What am I missing and why? For clients that are looking for yield and need a steady income stream, an alternative asset like private credit might be the right type of alternative for them. If you have a client who is probably more in the middle, where they're looking for some yield but also some capital growth, that would be something like real assets, so property or infrastructure. And the great thing about real assets is they also provide potentially an inflation hedge. And if you're a client that's really focused on growth, that might be an asset class like private equity or venture capital that might suit your needs more, where you're not looking for yield, you're looking for growth, and you have potentially a much longer time horizon to invest, then we would be recommending that type of alternative. It's hard to group them all into the same category because alternatives is such a wide-ranging asset class, but as a few general comments, I would say that they tend to have more illiquidity. That's really important for clients to understand. So you want to be compensated for taking that illiquidity risk. You want an additional premium above the listed markets in order to invest in that. And I think they tend to be less volatile because they are not priced necessarily on a daily or even weekly or even monthly basis. Many alternatives are priced on a quarterly basis, and what this does for your portfolio is it smooths the return profile because you don't have that enormous volatility risk within your portfolios. I would say a high performance portfolio is certainly in the eyes of the client about what they want to achieve. I think alternatives is playing a bigger role because it's providing diversification, it's reducing volatility in your portfolio, and it provides you a way to access the full market. I think there's some big trends that I see in portfolios, and you can play them across many asset classes, including the traditional markets, but also alternatives. I would say they really focus around what we call the Ds. So decarbonisation, deglobalisation, digitisation, and demographics. These are multi-year thematics in a portfolio, and alternatives tend to be longer term in their time horizon. I would say on the family office side, depending on how many generations are involved, the size of the family, their goals, there can be a lot of work around what do we want to stand for as a family, thinking about how you involve the different generations, your overarching family goals. That is a more complex and time-consuming discussion that has to go on with that family, and that can evolve over a long period of time. We have run a number of workshops with multi-generational families, and it may be up to 3 generations in the room, thinking about what they want to achieve with their family capital, what is important to them, what legacy and mission do they want to achieve. There can be a difference in how the generations think about what they'd like to invest in, and they may have different goals. So for example, for a much younger generation, they have a longer term time horizon. They may be able to take a higher level of risk, more illiquidity in their portfolio, a more growth orientated approach. For family members that might be older, they may be more interested in yield or regular return profile in their investments. And also overlaying that, I would say there's responsible investing and how the family wants to think about that. Many clients are far more sophisticated and educated about what they're looking for. I think younger generations within a multi-generational family office absolutely see the world a little differently, and they're very interested in their social impact and how their family money is being invested aligned to their value set. But I wouldn't narrow that just to the younger generation. I would say that across generations that is a bigger topic, and they're looking to their wealth advisor. There's a lot of benefit to working with a partner in that space, whether it's a wealth house or an advisor, to help you to get better access, and not just access, but also insight. Experience really matters in this space. It's a very high touch asset class. It has a lot of information barriers. The information tends to be more opaque. There's a lot more complexity in this space, a lot more specific terms and conditions that exist within alternatives. So having experience and having access to great tools and due diligence processes is absolutely critical.